At this point, I would like to introduce our speaker. Jeff Cardone is a partner at Luce Gorman, a law firm specializing in the representation of financial institutions nationwide, ranging in size from 100 million to 25 billion in assets. Jeff is also a returning guest speaker for us. He has been contributing to this event for well over 5 years. So Jeff, I'll turn it over to you and we can kick off with our disclaimer here.
Yeah, great to be here, everyone. Appreciate coming back. I think Jamie might have been, longer than that, actually. Hard to believe. Time flies as approaching your end. As Jamie noted here, we're doing this for educational purposes. Feel free if anybody has questions. I know at the end we'll leave some time, and we can certainly address those on this or even after the fact. If you want to shoot me or Jamie an email, I'm more than happy to do that. So what we want to focus on today, we're going to give sort of an update, things that Jamie and I have been seeing, from a accounting and legal perspective, and sort of the impact of the election and, what's sort of on the horizon in 2025, kind of things we're hearing, from our clients, from boards, from a strategic planning standpoint, capital, M&A, regulatory. So we're going to try to compass everything. I know we have a short time frame, so why don't we kind of kick in, Jamie, the next slide, on the M&A environment. So it's amazing where we were. If you go back to like June to where we are today, the general theme in 24, M&A, leading up to the election, M&A was down significantly at the bank level. The way I would kind of characterize the M&A environment, from a community banking perspective, was very unstable. We had a very unstable economic conditions, with high interest rate environment, which had a real adverse impact on bank stock prices. And why that's meaningful for a lot of these larger bank M&A transactions, the buyers generally use their stock currency to acquire a bank. So, when those stock prices become depressed, what tends to happen is those deals become more dilutive. So like, for example, if a bank, and forget what the market price is, if it's based on price to book. So if a bank's stock is trading at, 100% of book value or at book value, and you're trying to buy a bank and the seller wants a premium at 1.5 times and you're using stock, it becomes significantly dilutive to their shareholders because you have to pay up significantly more. And generally shareholders don't like that. The other condition we were dealing with throughout the year, also with the interest rate environments, was sort of the impact that the rates had from a purchase accounting mark standpoint. And what I mean by that, and not to speak for Jamie on the accounting side, I like to pretend I'm an accountant, even though I'm not, is when you put the two balance sheets together of two institutions. Now, this could be, whether it's a stock banks, mutual banks, credit union deals, credit union mergers, everything has to get fair valued for the assets coming over. And so a lot of times these underwater investment securities or loans with long maturity dates and low interest rates, because we were in such a low interest rate environment, which that increased, these get marked down significantly. And that has a real dilutive effect to the acquiring institution's capital. So that also made deal making hard. And then thirdly, what we were dealing with is, and primarily driven by the unrealized losses to sellers' bond portfolios, so they were recognizing higher AOCIs, which reduced the tangible common equity of these institutions. And that had a real adverse impact on pricing, because if you're basing price on price to book and your investments, your available for sale investments are way underwater, that's going to reduce capital, that reduced the purchase price. So all these different things and factors, we were in a more challenging environment. We had it was a very unstable M&A environment. It started to shift before the election, with the interest rates cuts. And now kind of things accelerated again, more on predictions of what's going to happen in 25, which are still unknown. So now what you're seeing is, you have the bank stock prices have done significantly better. I believe they're up like 25, 30%. which means, as I was alluding to before, better currencies means to more likely you're going to have deal making. You're seeing a very slight improvement to interest rate marks. So it makes that deal math work from a purchase accounting standpoint. That's still sort of an impediment to deals. And then lastly, whether you like the results of the election or not, we're in a more politically stable environment. And I think the street, the banking industry, the credit industry is feeling a little more bullish about the regulatory environment, that we're going to be sort of in a more streamlined process, although I'm not that bullish on that. So what's being anticipated in 25 and beyond is that M&A activity the pace of it's going to accelerate. The only thing I would caveat that from what we're seeing with that, even if we have the best, rosiest market conditions for M&A, is I do think what we're seeing is you're going to see what I call a supply and demand problem. The average size banks, the average size credit unions are growing significantly. Banks are getting and credit are getting smaller and smaller on the other side of the spectrum. So, in terms of putting deals, so if you're a bank and you're, looking to be an acquirer, there's less of a pool of buyers. And, conversely, if you're, sort of looking to sell, depending on, your size, if you're smaller, there's less of a pool of buyers. So that's sort of that's not going to change. That's just a product of, there's just less banks and credit unions today than there were 5, 10, 15, 20 years ago. And so while I think the pace of M&A is going to pick up, I don't think it's going to be where historically you saw 250 bank deals, 250 credit union mergers coming out of the financial crisis in 08. I think that's going to be less. But nevertheless, we definitely are in a much better environment. And I think M&A activity is going to pick up in 25.
So Jeff, specifically looking at the loan portfolios now, as you alluded to, the interest rates are getting more closely aligned than they were over the past year, right? With some of the, things that were on the balance sheet versus what the market prices are. Are there credit quality concerns out there as we're continuing to wait for, I hate to say, the credit quality shoe to drop? And then also, with the modeling and projections as it relates to the loan portfolios, I know everyone's been putting on a lot of adjustable rates as well. So how's everyone, I guess, dealing with that as it relates to modeling and what they're projecting?
And that was always the big unknown. And that was always the other side of the coin with rates, where credit quality. And but that, from knock on wood, has kind of held firm. And, but I would just say what you really have to spend a lot of time and thoughtfulness around because with variable interest rate environment, because you're right, with rates going up, can borrowers handle that? And could that have an adverse effect on balance sheets? So I think what we've been advising clients is really spend a lot of time on the due diligence front, not only on the modeling and the financial aspects of it, but really getting to the weeds on evaluating the loan portfolio. The quality of underwriting, stress testing that, looking at debt coverage ratios, things of that sort. And that's going to continue because again, and I know the regulators are focused on banks and other institutions that have, high CRE concentrations. Because even though we're in a more stable, knock on wood, economic environment, you can look around in your communities. There's a lot of empty office buildings, office space. And, these are customers and they're working with financial institutions and that's probably that's one of the big unknowns. And where that's going to land is, I don't know. Because that, regardless, even in good economic conditions, I don't know that how the trickle down effect that's going to have, because, people aren't necessarily going back to work 5 days. And so, yeah, that's a very meaningful component of M&A, and certainly something that you really want to keep an eye on from a due diligence standpoint. So this is another area where everybody's feeling better. The regulatory environment. What we've been seeing, bank to bank, credit union bank, and even credit union, deals are generally taking longer, and for a variety of reasons. I think the big thing we're seeing now is that the applications are getting more centralized. And when they go to DC, I joke deals tend to die, not die, but it's tremendously slow. So you'll be dealing primarily with the regional offices, but if it kicks to DC, they're sort of waiting on that, and things just take time. And hopefully there'll be some softening there, but that's going to probably take a little bit of time because even though we have obviously a new administration coming in, it's going to take some months before the regulatory, before the appointments are made. And then you have, the new, heads of the various agencies implementing their policies, and that has a trickle down effect. So, I mean, it's kind of stay tuned, but I think you generally have to plan when you're doing a deal and you find a dance partner. It's going to take, probably the next 6 months to a year of your business life is going to be devoted to that transaction. The other thing we've been seeing, and we'll kind of get into this a little bit about some of the policy statements that the regulators put out, is that, and this might shift a little bit, but there is a tremendous emphasis in these deals on whether or not these mergers meet the needs of the local communities. So we've been spending a lot of time in deals on products and services and mapping and the impact the deal is going to have. And we generally counsel our clients to sort of de-emphasize cost saves. And this even applies with credit mergers. You just want to be very, very careful because that is an area, and even impact of a transaction on the employees if they're going to be losing their jobs. And again, you look at the financials, and one of the drivers to obviously doing deals is efficiencies and cost saves, but that sort of gets reduced if you're not necessarily making fundamental changes. So there's sort of a push-pull with that, with the regulators on that, but they're hyper focused on that. And then this might be a good segue as we get into the next slide, but I know the FDIC, the OCC, the Federal Trade Commission all put out sort of evolving new policy statements, which kind of had a chilling effect on the M&A in the M&A arena. And, because their policy statements, they could be rescinded, what's going to transpire with that? This goes to our first polling question, Jamie.
So kind of coming back to what you were alluding to with the key factors, and I know you're going to talk about them a little later as well. When you're seeing an institution that's looking to take over or merge with a troubled institution, someone that either has capital problems or succession planning, are there any concessions that the regulators are looking at there, since they're basically assisting an institution that is in trouble per se, or is it really the guidelines are steadfast no matter what the situation is?
Well, yeah, I don't know that they're more for the most part, our experience, subjective than objective. I think the general view on that point for an institution that's troubled, or we've done deals, for example, where you've had an institution have an unsatisfactory CRA rating, and whether it's bank to bank, and then for credit union bank deals, obviously credit unions aren't subject to CRA. Usually what the regulators are looking for is if the merger or the transaction kind of fixes the problem, they tend to be more receptive. It's not like, oh yeah, you're unsatisfactory, we're absolutely not going to approve it. But like if a seller has regulatory issues, whether it's fair lending, BSA, that kind of thing, but the acquiring institution does not, that's generally the messaging you want to present to the regulators, and that's generally got us over the finish line on that. But the flip side of that is that if you're looking to be the continuing institution or the acquirer and you have regulatory problems, that could be problematic. And really what you want to do is just be very transparent and have outreach with your regulators, because clearly during that kind of planning phase before you move forward, because again, you want to put your best foot forward, but clearly if there's going to be an issue, you don't want to then be signing up a definitive agreement, spending all this time, money, expense, having a deal signed up, doing applications when the regulators aren't going to approve it. So the planning process, that's going to be important if you're an institution that has hair on it from a regulatory perspective. So this is a good shift. So interestingly, to kind of take a step back, bank mergers are evaluated under the Bank Merger Act. And regardless, so there's a little bit of push and pull because you had since the 1800s, the antitrust laws, which the primary regulators overseer of that is obviously going to be the DOJ and the Federal Trade Commission. So in 1995, because generally the bank regulators are going to be the arbiters, and the DOJ generally doesn't get involved, particularly for smaller deals. The DOJ and the bank regulatory agencies put out joint guidance in the 90s about how they would evaluate mergers from an antitrust perspective. And what happened, and I think this had a real chilling effect, particularly for larger deals, was that in 2023, the DOJ put out new merger guidelines that apply to all industries, including banks. And there was sort of confusion because you had these new merger guidelines that was omnibus to everybody. And then you had the 1995 guidelines that were DOJ that were specific to banks. And what DOJ did was they actually withdrew from the 1995 bank merger guidelines. And I think the reasoning behind that, now we haven't seen this had a real meaningful impact on community banks and smaller deals, but I think this was designed to give DOJ broader authority to regulate larger transactions. So like, for example, in these 2003 omnibus merger guidelines, they look at, there's a lot of subjective, qualitative, discretionary, features of that, how M&A deals are going to be evaluated. Like, for example, I have here on the slide, eliminate substantial competition between firms, or creates a firm or bank that may limit products or services that rivals use to compete. Very broad, no specific objective guideposts. And so again, I think that was designed to reduce predictability and to give the DOJ broader authorities. And I think this had a real impact on, you saw like large M&A deals really, during the last 2 or 3 years have really slowed, I think, for this reason. So the hope is with the new administration is that the pendulum's going to kind of swing the other way, and that DOJ is going to go back to, the 1995 guidelines, or kind of have it where these 2003 merger guidelines don't necessarily apply to bank mergers. For credit unions, while this is impactful, credit union mergers are always under the purview. They don't have the same deference that bank mergers do with DOJ and the FTC. But that said, I mean, because there's no deal consideration involved, nonprofit generally, and there are filings with DOJ for large credit union mergers, they're not necessarily, there's not a real point of emphasis for that because huge concern on there, but nevertheless, something to kind of keep an eye on with that. FDIC OCC policy statements. So, interestingly, we were involved in a couple larger bank mergers that went on for like multiple years. So there was a lot of like pushback to the FDIC and the OCC in particular, at the DC level, just how long things were taking. And the FDIC and OCC issued policy statements earlier this year, and just sort of bring the light, kind of, okay, here are things that we're looking for, here are sort of key indicators that if you satisfy these criteria, we're going to process your application more efficiently. They sort of highlighted things that we were already dealing with, particularly as it relates to community banks, managerial financial resources, things like, if you're undertaking multiple deals at once, they're going to look at your integration planning, they're going to review management, all these different things. And, and the other point of emphasis was this convenience and needs of the community. And basically what the policy statements have said, the things we were dealing, what I was alluding to earlier, is that there's been a tremendous emphasis on the impact of transactions on consumers. And they're looking at things like, and this is in the policy statements, will the transaction better serve the community? What are your specific branch closure plans? Focusing on job losses, things that that was there that you wouldn't, but that we were dealing with. But the policy statements, what you can, and a lot of people's views of these was more, I think the goal was transparency. I think a lot of the takeaway was this is sort of designed to slow down M&A is really what was really the premise of putting these out.
Coming back to the managerial and the financial resources, I know that obviously there's a lot of planning that goes into the merger process, but is there additional regulatory oversight, post-merger? Like, are you meeting the required or the capital projections that you made, and so forth? And is that part of this as well?
Yeah, no, that was a great question or point. One of the things we've been seeing, so on the capital front, what we've been seeing, and if you've been following some of these larger deals and you see press releases, you're also seeing in conjunction with deal announcements, capital raises happening sort of concurrently, whether that's equity or sub debt. And the reason for that is now the regulators are hyper focused. We talked about the key indicators here, is what is your legal day one capital? Because what generally used to happen, I mean, you sort of had to be well capitalized, but if you did a deal that kind of took your capital down, but you can show in your projections that you're going to have a pretty short earn back period where you lose. So if you're at 10% capital or net worth and you go down to 7%, but you can show the regulators, well, I'm going to get back to 10% within 2 years, you're generally okay. Now they don't really care as much about projections, but really hyper focused on that legal day one. And that's why you're seeing a lot of capital raising being done as part of these transactions, which historically investors didn't love that, but now they're more receptive to it. And then on the credit union front, that's why you're seeing a lot of credit unions, whether they're being acquisitive of banks or even credit union mergers, because of the concerns about pro forma capital, to the extent they're eligible, and we'll talk a little bit more about this later on in the presentation, is sort of getting pre-approved to issue sub debt, just in case they need that to sort of enhance their capital ratios, again, on legal day one. There are some useful things in the policy statements. And, they do list, and again, these aren't any surprises, but sort of they identify, particularly the OCC's policy statement. So, it doesn't necessarily mean 100% because there's some unfavorable finding or factor that your deal can't get approved, but they do list things that are concerning. The obvious, like you're not in compliance with applicable federal or state statutes, rules, regulations. They assess the unsafe or unsound condition. That kind of gets to the capital discussion we just had. Less than satisfactory examination ratings, particularly on the CRA front. And I think that's more meaningful for an acquiring institution. Significant concerns have been related to financial performance, condition, risk profile, inadequate management. This last one, incomplete, unrealistic projections. This is very, very important. If you're doing a deal and you're working with your financial advisors, accounting firms, you want to make sure you're using very conservative, deal assumptions, whether that's transaction expenses, the impact of the purchase accounting marks, projected earnings on a pro forma basis, because you want to have real credible projections when because all that's got to get filed with the regulators, whether you're doing, bank merger, credit union mergers. And we've been seeing a lot more comments around those projections. So you just want to spend time making sure you're working with reputable advisors on that, because that's certainly been an area of focus. Things we've been seeing is on the projection aspects of the pro formas.
So Jeff, as we flip to the next slide, I guess I have a question as it relates to if you're an institution and you're looking to merge because you have succession planning issues, perhaps, and the length of time that it's taking to get these deals approved, have you seen any significant deterioration with institutions because of the length of time that it's taking because those plans aren't in place and it's it is negatively impacting them?
Yeah, I mean, you know, it, and that's always the argument we've made with the FDIC. I mean, I would just say out of the three or the four federal regulators, with NCUA, FDIC, OCC, the Fed, FDIC has been the worst in terms of taking the longest. And I think they do lose sight of the fact that their goal, particularly, an institution that's has financial condition issues, the more you can accelerate the review process and get the deal consummated, the better, because of the risks you're losing. One, just the financial condition, particularly if the bank's losing money. Plus, there's steps that an institution has to take to prepare for a transaction. They're going to incur more transaction expenses, depending on the deal. They may have to, like we've done deals, like as an example, where a seller has a cannabis related businesses that a buyer doesn't want, and they have to run that off. Or situations, I know this comes a lot in credit union bank deals, where credit unions can't assume municipal deposits. This is in New York as an example for the two deals we're working with there. And so banks have to take steps to deal with that, and that deteriorates their financial condition. So that does have an impact. And then and you're right, and then on personnel. And what happens as you're waiting around, how to ensure. So I do think as part of this, you do have to prepare for a longer process. There needs to be sort of contingency plans in place, and also you want to make sure you're incentivizing key personnel and management teams to stay so they can kind of ride the ship until the transaction consummates. Generally on the personnel front, we haven't seen runoff because a lot of the deals, this kind of goes to, you may not be the most efficient, but it is important. And I know we counsel a lot of acquirers to really, don't go too cheap on compensation if you can. Like you want to have good retention bonuses. You want to make sure you're messaging to the employees early in the process. There's a role to you, and situations where there might be some overlap, like particularly for like the financial jobs, whether it's a controller or CFO, but at least offering, if they're not going to, there's not a role long term, at least having good retention bonuses to kind of button that up, I think is definitely warranted in terms of being prepared for the longer environment. As far as the takeaways, you know, I what some of the things I've been reading or hearing, I think we're going to see a lot of change with the FDIC level. I know with these policy statements, I know publicly the vice chair and the Republicans highly criticized the FDIC's policy statement. I mean, their argument was that it was going to make the process longer and less predictable, which was sort of true. But that said, I don't, whether deals are going to be more centralized, I do think something to keep in mind. I think what also set us back is not so much liberal versus conservative. And I think you have to keep in mind too, we had tremendous bank failures in 2023, and the regulators took a hit on that. So I think, and that's also been part of the reason why things have slowed down. So even though we're going to have significant changes in personnel at the regulatory agencies, I think they're still going to be cognizant of that. So for example, why I think there might be some positive shifts on timing. I don't think it's going to be, we're not going to go from like, if it takes typically 10 months to approve a deal, I don't think it's going to go to like 3 months. You might shave off a month, or there might be more transparency around that. So I still think you have to be prepared that if you're going to move forward, whether it's bank to bank, credit union, that it's going to be a lengthy process to get your transaction approved and integrated.
Okay, we have polling question number 2. Based on the election results in 2025, how's your organization feeling about 2025? Optimistic, pessimistic, or neutral?
So real quick on the M&A front, and then before we shift to, regulatory and some of the other non-M&A and capital, sort of our predictions. I think you're going to, we're anticipating more what I call merger of equals in 2025. Um, and merger of equals doesn't mean necessarily you're going to have two exact size institutions coming together where there's going to be an even split, at the board. It's really more primarily the characteristics of MOEs or merger of equals are they're primarily stock deals. From a seller institution standpoint, there's significant representation on the board, also on the management team. And I think what's going to drive these as well is what I was alluding to before, the supply and demand problem. Like what we're seeing now, I mean, if you look in the bank industry, even in New York, you have, the banks that were historically in that 500 million to $1.5 billion range, asset size wise, has gotten less and less. And so you still have small banks, but that group is gone. So the acquirers who were in that 3 billion, 4 billion range, who would historically, those would be the asset size targets because the smaller guys are too small, are now thinking, okay, if we're going to grow, our only realistic option is to do sort of more of a strategic deal with our contemporaries. And so we've been, involved there, some deals have been announced. We're certainly a lot more chatter going on. That's certainly something we're seeing. The only thing I would caveat to these deals, and they sound good in theory, they are hard to make work from a social issue standpoint. And I always use this analogy. I think I stole this from somebody with merger of equals. Think of a cookie jar with 5 cookies. Somebody's going to get 3, somebody's going to get 2. Somebody's going to be, it's hard if you're the entity with the 2 cookies. You still have significant say, but you're still giving up control, and that can be challenging for boards. And we end up, and I joke, it's more like therapy session with boards than than deal making. So I think if you're entertaining that, and this goes for credit unions too, for credit union mergers, think about kind of like your must-haves or things that you can live with from a board seat perspective, management team, compatibility of culture, those kind of things. Because that's going to be important. That's going to drive a lot of the deal making or the conversations that you may be having or plan to have in 25 and beyond. Credit unions buying banks. Um, there are, I'll give you my take on this for a couple things. I think, there are sentiments from primarily driven by the banking trade groups, that credit unions sort of have an unfair advantage because they don't pay taxes. They can use that advantage, and they're coming in and they're just buying banks left and right, and selling banks don't have any other options, and they're being forced to sell. I could just tell you that a lot of that is baseless. And there's a couple things to kind of keep in mind. So in 2024, we've had a quote unquote record year of credit union bank deals. It's 20. Since 2012, which I believe was the first credit union bank deal, there's been a total of about 80 credit union bank deals. During that time, the number of credit union to credit union mergers and bank to bank mergers was roughly 5,000. So these deals, while you're seeing more and more of them, represent a very, very small percentage of the M&A pie. While I do think they're going to continue in 25, you're not going to have this mass where you're going to see hundreds of credit union bank deals. I think it's going to be within range around this number. I think in 24, they got a lot more attention is not because of the number of credit union bank deals. It was really more the denominator, the number of bank to bank deals, because dropped significantly for the reason I was alluding to on the first slide. So, because there weren't large mergers that were getting more attention, these deals were getting more attention, the credit union bank deals. Historically, they've been highly concentrated, within the Midwest, the Southeast, the Pacific Northwest. One interesting change in 24 was now it's in New York. You had Hudson Valley Credit Union, acquiring Catskill Hudson Bank, ESL in Rochester buying Generations Bank, and we've been involved in both deals. So yes, so New York, there's now sort of a regulatory framework to do these deals. But again, for the reasons I was alluding to, that doesn't mean you're going to see every bank in the state selling to credit unions. Now, the
I
other
do
thing
think,
oh, go ahead, Jamie.
no, I think the interesting things with these, Jeff, and I think you alluded to it earlier, is the structure of the deals, right? Because it's a purchase and assumption and it's an asset purchase. That like said in a previous slide, that there are assets and liabilities that the credit unions are not taking, right? So there's almost a two-step
Oh yeah,
settlement, process that's lengthier in nature, just because of the way that the deal is unfolding. So there are additional complexities, I think, as it relates to these, even though, there's a lot of benefits
bingo.
that you're listing here as well.
Oh yeah. No, no, they're highly complicated transactions. So that's why, like, and it's funny, the trade groups are opposed to it, but for banks, one, my view is, and my counsel to boards from a fiduciary duty standpoint is, one, why would you want to limit optionality? That doesn't mean, and I'm not saying this to be an advocate or somebody against it, but a lot of times, credit unions maybe your best bet for maximizing shareholder value, number one. And number two, if you bring them into the process, you might be able to get a better price from other banks. But to Jamie's point, what also tends to happen is if you have a credit union bid and you have a bank bid and they're generally close, or even if the credit union bid is slightly better, a seller's generally going to go with the bank for that reason, because of the P&A structure of the deal, things like certain assets and deposits that credit unions can't take. Um, and so they're very complicated. They generally take longer to get done because you have more regulators involved. So they're harder transactions. That's why, like, this idea that you're going to see this mass wave, it's just not going to happen, particularly now with the economic conditions getting better and you have a lot more traditional acquiring banks get into the fold. There's going to be more competition. I mean, so there's going to be deals in 25, but it's not going to be like this mass wave, is where I'm getting at with that. We're also going to expect to see larger credit mergers. There was a very large one in New York that we were involved with, SEFCU Capcom, that closed in 23. That's now combined like 8 billion in assets. I know there's a lot of chatter throughout. And sort of the same reasons, you see bank mergers, you're seeing these larger credit mergers, a little bit of the supply and demand problem. The mid-sized credit unions are being are merging out. And so now for these larger ones, doing a deal with a small little credit union isn't meaningful. So now there's more openness to combining with other credit unions, to do larger deals. What I would tell for credit unions out there, these deals similar to MOEs, they sound good in theory, but they're very, very challenging to make work because of the social issues. And again, here there's no deal consideration involved. So the key, I think, if you're going to sit down and do one, or you start that process, the boxes you have to check is, one, you got to make sure you have a mutual commitment for the management teams and the boards. If there's dissent at the board level, and I've seen credit unions try to do deals, that could create risks and lead to non-approvals, particularly if they're trying to undermine the process, and that could have adverse consequences of trying to get the member vote. I think you want to have a real thoughtful letter of intent term sheet that outlines all the key operational, social matters related to transactions. You want to be very specific, whether it's things like charitable contributions, composition from the board, supervisory committee, compensation, all these different, and even bank to bank too. Because again, you don't want to waste all your time and energy when you're doing due diligence, negotiating agreements, which is real cost, if you don't have a meeting of minds on sort of these key principles. You want to have a thoughtful supplemental merger agreement. You want to, again, make sure that you can get the member vote, deal with compensation. So all these different things are very, very important. But that said, I would anticipate seeing in 25, there'll be more announced larger credit union mergers.
Yeah, I was thinking, Jeff, with the member vote, do you think it's more challenging to obtain that than it is for a shareholder vote with a bank? Because I mean, I feel like I've seen more of these fail than banks.
Yeah, I mean, so credit union mergers, it's one vote for one account. You generally don't need a high quorum to get it and a majority, but what obviously tends to happen is The members that are in favor or against it are loud and they're the vote no. The ones that don't care, like, yeah, sure, whatever, tend to not vote. And so where there's been issues of getting the vote, that's been a problem. So when we say like planning for the membership approval, you may want to think about it from a PR perspective because you want to make sure you can get the requisite vote. Where shareholders, again, because the driving force is going to be the financial aspects of it. So if it's a good price, you're generally going to get the shareholder vote. One other tidbit, this was noteworthy. I don't know how much we're going to see, but in Massachusetts, there is a bank acquiring a credit union. So legally it can be done. The one caveat to that, regardless if the acquiring bank is a mutual or a stock bank, is the membership equity or net worth has to get paid out. That's one of the prerequisites from the NCUA. It's sort of the approval process. And what that is they mandate that you have to determine what the merger value is, whether it's through like an auction process or through an independent appraisal. But that's something that would have to happen. And then there's sort of this, NCUA has sort of this, complicated notice requirements and things of that sort. There's a higher voting threshold, but the answer is yes. Like banks can acquire credit unions, and so maybe we'll see another one in the near future. You might see that again. New England's kind of unique because a lot of the banks are mutuals, so there's a lot of synergies there. But that might be something you might see in 25.
Right. So now we're going to move on to capital.
Yes. So real quick, and I know we don't have a ton of time left. Again, similar with M&A, what a shift, because going into, a few months ago, capital was challenging. On the sub debt front, I'll start there. I mean, coming out of the COVID with interest rates being so low, I mean, the sub debt market was like very, very robust. Low interest rates. You saw banks, particularly banks under 3 billion in assets, because the debt at the holding company doesn't count against you from a capital perspective. We were probably doing like 5 or 6 a month sub debt deals. With the spike in interest rates, the sub debt market, not saying there hasn't been deals, it's definitely quieted for that reason. The flip side of that, with stock prices being down leading up to recently, the common equity markets were very, very quiet. That has been a complete shift. I mean, the common equity market right now is very, very hot. We have a lot of banks doing common equity raises. So if that's something from a bank perspective, you're thinking about, now is a really, really good time because stock prices are better, investor sentiment's much higher. They're open to, doing these deals. And it's a really good time if you need capital to get it, particularly if sub debt is not going to be viable because of its expense. On the conversion front, sort of the same thing. I think valuations. So we have clients that are doing mutual stock conversions, valuations are much higher, meaning you can get more capital to the bank. So that has been very robust as well, which we're anticipating in 25. So 25, I think, a lot more common equity raises. I think you'll still see some sub debt as the only viable options, but interest rates are still high on that.
Before we move on to capital and credit unions, we do have a question asking about social issues in M&A. They allude to the fact that it often seems like an ego issue. Have you seen an effective way to deal with this when it's just a few members of the board or management that seem to have an ego that's getting in the way of the merger?
Yeah, that's a good question. I think one board seats, putting those people on the boards can really help. And if that's not feasible, kind of having sort of a meaningful role for them, whether vis-a-vis an advisory board, is one way to do it. The compensation front you could do, although the regulators generally frown upon that, like paying directors, particularly if this is like credit mergers, because then it's like, are you indirectly kind of buying a vote or support? Is the challenge. I mean, each organization is sort of different, but or thirdly, we've had situations where, if the strategic vision of the board is to do, to grow vis-a-vis an acquisition and these board members are not on board, then maybe they need to step aside. You hate to say that, but And we've had situations like that. One, it was more at the management team level where the CEO was not supportive and the board decided that it was best for the parties to move on because you're just not on the same page. So dissent is okay, but like once you kind of reach a conclusion, then board, you'd have a fiduciary duty to kind of carry it out. So you have to kind of be careful of that. It's a balance. But generally at the board level, I think board seats or putting people on the board solves a lot of the problems. If not, then then you might have to kind of think elsewhere, maybe whether it's advisory board or potentially those board members, rolling off because they're not on board with this long-term strategic vision of the organization. On the capital front, credit unions can issue sub-debt. And the NCUA in 22 expanded their rules. So if you're either low income designated or greater than 500 million in assets, you can issue sub-debt. And sub-debt is just like a borrowing. You're literally borrowing money. It's unsecured. But the beauty of it is it gets accorded regulatory capital treatment. That's like the why versus doing like an FHLB borrowing. So for credit unions, if you're low income designated, it's accretive to your net worth. If you're not low income designated, it's only accretive, the sub-debt, to your risk-based capital. But what we're seeing with a lot of credit unions for planning purposes, not necessarily issue because it's higher interest rates, is that they're going out and getting, to the extent they're eligible, they're getting pre-approved. So it's almost like a line of credit under the NCUA rules. You have 2 years to issue, but it's sort of something to think about because you can get pre-approved. Then once you get pre-approved, then if you need that capital, you can get it in a matter of weeks instead of going through the full regulatory process, which would take months.
And I thought the note at the bottom is interesting that you can't own it and
Yes.
issue it, because unlike a bank that could do that, obviously.
Yes, that's one of and that's a good point because primary investors of sub-debt is other credit unions. So if you're looking to potentially do it, you may want to like sit tight on the investment front. Now, doesn't mean if you do invest in sub-debt and you want to get pre-approved, you can. You just have to tell the NCUA like your plan to be eligible, which would be we'll sell that sub-debt investment if need be. This is, from a regulatory perspective, while capital plans are getting more robust and we're thinking, and you're seeing more and more, particularly on the equity markets, I think it's important to keep in the back of your minds, your organizations, at the board level, management teams, risk management perspective, is think capital with the risk management function. So when you're kind of planning your strategic plans for 25 and beyond, just think about it in the purview. You always want to think about it from capital and liquidity. And, do we have the capital to support those plans, whether that's, doing acquisitions, organic growth, doing de novo branching, whatever it is you're doing, you want to make sure that you have the capital plan to support that. And then the other thing to think about is, this is very, very important, is sources of capital. Because we work with a lot of closely held community banks that don't have, they're not publicly traded and they're very closely held, and common equity may not be politically feasible because that means you're going to have new shareholders at your institution. You may not want that. So that means then your only other alternative for capital outside of organic growth is going to be sub-debt. And do you want to, if you need are you ready for that? Can you pay the higher interest rate? I think for credit unions, going back to what we said earlier, I think thinking about getting pre-approved. So you do want to look at capital planning with a risk management lens in addition to the strategic lens in 2025 beyond. And certainly this is something, regardless of changes with the regulatory agencies, they're definitely going to be focused on this, capital plans and risk management.
Let's move into regulatory. Oh, we have another polling question. What third parties are key to a successful M&A process? Legal counsel, accountants, investment banker, valuation specialist, all of the above.
Well, that's the obvious, Jamie. Of course, legal counsel, not accountants.
All right, so regulatory.
So we're definitely going to see a fundamental shift at the personnel level. Interesting. We expect, for the OCC, Michael Hugh is going to be replaced. Interestingly, tidbit, he was not confirmed. But so it's very likely the new OCC comptroller is going to be confirmed because we're going to have a Republican controlled Senate. There's going to be big shifts at the FDIC. Certainly, I think that Travis Hill, who's more conservative, is poised to replace Marty Gruenberg. I mean, he's kind of had a very controversial, at his time at the FDIC for personnel reasons and the like. At the Fed, I think Michelle Bowman is obviously very, very popular in the community bank circle. So we would expect to have a more active role and really, really drive a lot of policy at the Federal Reserve and not necessarily just be a dissenting voice from the Fed perspective. And then at the NCUA, we're probably going to see a new chairman, which speculation is going to be Kyle Haptman at the NCUA. But again, it's going to take time. The new chairperson's coming in is great, but it's going to take time to have that trickle down effect and how that's going to happen. It's going to take, so that remains to be seen but certainly there's going to be a shift with the new agency appointments.
And I think too, we're obviously watching the SEC and the PCOB and the shifts that we're anticipating there as well, with a new chairman of the SEC and what's likely to happen with the leader at the PCOB, which should, I hate to say, be beneficial for all. So.
Yep. So I think everybody's, and I think this is what's driving stock prices. I mean, there's anticipation of deregulation. I don't look at it deregulation. I view it as priority. And I think some of the things that may change, I know there was more stringent capital rules for larger banks that, this Basel Endgame proposed rule will probably get shelved. We talked about the merger guidelines. There could be some shifts. I know the FDIC put out proposed corporate governance guidelines, which may change. The FDIC has that controversial broker deposit rule where, with fintech, the impact of the fintech industry on that, all that could change. The only thing I would caution before you get too cheery about it is that what we saw going back during the last Trump administration is that if there's a little bit of deregulation, the state regulators tend to pick up the slack. So for you banks and credit unions that are state chartered, be very, very mindful of DFS. And I would anticipate them still being very proactive, particularly things like fair lending and the like, and ESG related type matters. And then the other wild card is that this group of Republican policymakers are very populist oriented. So that may have a chilling effect on, fees. Whether I know there's been proposed legislation around caps on interest rates and some of the consumer related protections. Well, I think the CFPB is going to get watered down. I mean, that's something to kind of take an eye on. That's why I kind of call it deregulation or priority with a twist as we go into 2025. I want to be cautious and judicious and not say, oh yeah, when the regulatory environment's totally changed. I don't know that's going to be the case. And just real last, because I know we only got a few minutes, I will tell you this, off the record conversations we've had with various regulators, and we have good relationships, whether it's the NCUA and the federal agencies, what keeps you up? And we always ask, like, kind of what keeps you up at night? What are you thinking about? The big thing that they have that they're focused on, and I don't think this is going to change, is cybersecurity and really managing your third-party vendors. Because the whole host of banking's changed. There's more fintech relationships, more sharing of information, all these different things. And I think you just want to make sure as your organization that you're very robust, that you really are prioritizing risk management of your third-party vendors, and just making sure on the governance piece that not only are you managing it, whether you're doing it like from your risk office standpoint, to do that, make sure the board's aware of what's going on. Corporate governance, being a director has gotten a lot harder, and there's a lot higher expectations on board members with respect to risk management. And I don't see that really changing in 2025, even if they water down some of the corporate governance rules. So some of these things, are good. And these are principles from the FDIC guidance, but, making sure you have robust independent directors, board duties, tone starts at the top, making sure you have robust policies, code of ethics, active oversight of management. Also making sure the board is briefed on what's going on are going to remain very important in 25.
We already talked about the
board
committees. Yep.
Yep, board committees, we talked about that. The other thing to think about too is succession planning. I know from the NCUA perspective, they have rules around that. And certainly this is still going to fundamentally drive M&A regardless of the economic conditions in 2025. So this is something to think about. And we talked about earlier, Jamie and I, about the compensation piece and incentivizing your people to stay. So that's something to sort of definitely keep an eye on or prioritize in 25. Jamie, you can go to the next slide because I know where that. Let's just talk real quick.
Yep.
Or you even go to the next one. I was going to go to the
non-compete.
Yeah.
Okay. There's one last polling question.
Yeah, and this is going to change. I mean, FTC they banned non-competes with caveats and exceptions. And even for banks, you'll kind of look to the FDIC or the bank regulators on that. The rule was overturned by in Texas, and it's likely that the FTC is going to withdraw its appeal under this new administration. But kind of like I said, deregulation with a twist. Be careful of New York, because obviously they're very, very labor friendly. So they may step in and have more robust rules around non-competes in 2025 and beyond. So, but that was it, Jamie. So I think I don't know if anything else to add, but again, it's always been a great pleasure to be here and with our good friends at Bonadio. And feel free, if anybody needs a copy of the presentation, follow-up information, feel free to reach out to me and certainly reach out to Jamie as well.
Thanks, Jeff. We always appreciate you joining us and the insights that you provide. So thanks everyone for joining us. We hope that you found this session informative. As we mentioned earlier, you will receive the presentation materials within 2 weeks of the conclusion of this event. If you do have any questions, as Jeff alluded to, please feel free to reach out to either one of us. And we look forward to having you back for the other sessions this week. So there are 3 tomorrow and there's 3 Thursday as well. So thank you and have a good day.
Thanks, everyone. Take care.
Thanks, Jeff.